What happens if you sell a house in a QPRT? Have you ever wondered what happens when you sell a house that is part of a qualified personal residence trust? This is an important topic in estate planning, and understanding it can help you make informed decisions. A qualified personal residence trust is a unique estate planning tool. It allows you to transfer your personal residence into a trust while still living in it for a set period. This can help reduce the taxable value of the gift to your heirs. Now, if you decide to sell the house that is held in the Qualified Personal Residence Trust, there are specific rules to follow. First, it is essential to consider what you plan to do with the proceeds from the sale. If you sell the house and do not buy a replacement residence within 2 years or before the trust term ends, the trust will lose its Qualified Personal Residence Trust status. When the trust loses its status, it must either distribute the sale proceeds back to you, the grantor, or convert into a different type of trust called a grantor retained annuity trust. This new trust will pay you an annuity for the remainder of the term. This conversion or distribution must happen within 30 days of the sale. However, if you do purchase a replacement residence within the 2-year window or before the trust term expires, the Qualified Personal Residence Trust can continue to hold the new residence. The new home must be of equal or greater value and must be used as your primary residence or one other personal residence, just like the original home. The trust agreement should allow the trust to hold the sale proceeds temporarily until the new residence is purchased. If the new home costs more than the sale price of the original home, the Qualified Personal Residence Trust will only hold a portion of the new home. For example, if the original home sold for $1 million and the new home costs $2 million, the trust would own 50% of the new home, and you would own the other 50%. From an estate and elder law perspective, selling the house in a Qualified Personal Residence Trust does not undo the estate planning benefits already achieved. The gift to your beneficiaries remains intact, and the property is still removed from your taxable estate, provided the trust continues to meet the requirements. Additionally, because a Qualified Personal Residence Trust is generally treated as a grantor trust for income tax purposes, you may be able to exclude capital gains on the sale of the principal residence, subject to standard Internal Revenue Service rules for principal residence sales. The cost basis for the home in the trust is typically the value at the time the trust was created. This means heirs do not get a step-up in basis when they receive the property after the trust term ends. Selling a house in a Qualified Personal Residence Trust requires careful timing and reinvestment to maintain the trust status and its estate planning benefits. If you fail to acquire a replacement residence within 2 years, the Qualified Personal Residence Trust will convert to a grantor retained annuity trust or distribute proceeds back to you, changing the trust's tax and estate implications.